Ethan Harris is head of global economics with BofA Securities, and he joins us. Ethan, what's your base case for Fed tightening at this point?
Well, we don't think they're going to actually get going until 2023 in terms of rate hikes, but they're on the verge of doing tapering, so we'll probably hear a bit about that in the minutes.
When you say on the verge of tapering, you still expect a November announcement, maybe a December start date?
Yeah, that's about right, and we think they'll also have a fairly short time frame for ending the tapering, so probably next summer.
Okay. Let me turn to Bob Bassani. Bob, with a look at what the market is expecting for the Fed here in light of all the supply chain issues we're facing.
Yeah, this is a very delicate moment for stock investors. You know, Steve was talking earlier about the possibility of the Fed moving up the timeline for hiking interest rates, maybe even back to September of 2022. This makes stock investors very, very nervous because historically, one of the great killers of bull markets has been a Fed policy mistake, which the market means sudden, unexpected moves up in interest rates by the Federal Reserve. That's a worry. The problem is the Fed might have to react to another great killer of bull markets, which is sudden spikes in inflation. This has not been a problem for a long time. It was a huge problem in the 70s, even in the mid-2005, 6, 7, when we had a commodity boom. Oil prices doubled in 2007. So it's been a long time since we've had a problem. That's why the market's very worried about this move up in oil. If oil goes now even higher from, say, 80 to 100, that's not good for stock investors. They're going to be worried the Fed is going to move up its timeline even more to deal with commodity inflation, particularly energy. So it's a very delicate moment right now for stock investors.
Mike, turn it over to you. In July, officials from the Fed, they really stressed that they don't believe there's any real link between tapering and interest rates going higher. We've seen interest rates go considerably higher as we've reached closer and closer to November. Do you see a link, and how do you see the markets reacting if these rates continue to go higher?
Well, the Fed has obviously taken pains to try and separate the idea that tapering, they want to get kind of out of this mode of buying $120 billion in bonds every month and separate that from when the Fed itself eventually raises short-term rates. And I think they've mostly succeeded in doing that. I find it fascinating. The current debate is not about, boy, won't the taper be scary? It's the market attempting to try and anticipate when the first rate hike will be. Maybe they've pulled it forward a little bit right now, but it's not because the tapering process is about to end. So on that front, the Fed's probably been pretty successful. But yeah, I mean, market-based yields, longer-term yields have become a little bit unstuck. But I have to say, they've not necessarily gone to the levels where you'd feel as if they were a threat to growth. By the way, we're also going to be kind of anniversarying the very hot inflation numbers of this spring in 6 months before most likely the taper's over. So it could change the whole discussion about whether, in fact, there's urgency, because inflation is measured this year over last year. And next year, we're going to be going over a year that was pretty hot.
Yeah, absolutely. And let's just take a look at all three major averages, which are at session highs right now, more than erasing those declines we saw at the beginning of the morning. The Dow, the S&P, and the Nasdaq across the board are in positive territory. The Dow is now up about 14 points. We're seeing the headlines roll out here. Steve Leisman has all the details for us. Good. Steve?
Yes, thanks very much. Just a very quick read of these minutes here. We have more to do, but they did discuss the timing of the taper. The committee concluded that a gradual tapering process was likely appropriate. Participants generally agreed on a taper concluding around the middle of next year. That would put you in about the $15 billion a month reduction each month in the amount of asset purchases. They said that if the decision was made in November, the tapering could begin, by the way, it says here, this is sort of new, mid-November. That's the earlier time, or mid-December, which is when more people had expected it. Most participants saw that the substantial further progress criteria that they had set out for both employment and inflation had been met, allowing for the tapering to proceed. The increasing funds rate would depend on the path towards the Fed's goals, of course, and they were clear that tapering provides no signal about rate hikes. I was just about reading the inflation portion of the segment there, Kelly. But heck, if I do that in 3 minutes, imagine what I'd do in 2 more minutes.
Thank you, Steve. We'll come right back in a moment. Ethan, do you want to just react to this?
Yeah, I think it's very much what we expected. Start going in November, finish by middle of next year. And let's keep in mind, the Fed's been telegraphing this for a while. This is not a shock at all. I think that the market is correctly focused on rate hikes. That's where the real danger is, not this slow motion exit from bond buying. So nothing really new here, I think.